Hello and welcome to the Weekly Market Metrics. I'm your host Sandeep and we are in week 27 of 2026. And if you were working towards a six-pack abs, by now you should have had three. I'm just saying. Moving on to what happened last week, well, for the first time in close to 3 months, I don't really have to start with some news about the Iran war. Thank God for small mercies. But if you still want more reasons to feel bad, we have the news where Donald Trump apparently made more than $1 billion in crypto, not by trading, but through licensing fees and such. And in another news, both Sri Lanka and Vietnam have been upgraded to upper middle income status by the World Bank. It's interesting to note that the two countries took a very different path to get there. One is a story of recovery and resilience, and the other is that of consistent export-led growth. But as you all know, I am a glass full kind of a person, and the good news is that the markets closed in positive this week, with Nifty up around 1% over the week, trading around 24,250 as of Friday's close. And in general, I see a positive second half of the year, fingers crossed. With that, let's look at what happened last week and what could happen in the coming week. And yes, I did a small study of global index performance for 2026, and if that interests you, don't miss that towards the end. So without further ado, let's start with the rate of change across indexes. Starting with the headline indexes. Another fairly quiet week across the headline indexes. Nifty 50 gained 0.9% while small cap 250 and micro cap 250 once again led the pack, both up around 1.5%. Mid cap 150 also edged higher, adding 0.6%. The broader story remains unchanged. Micro cap 250 continues to dominate over the last 3 months, while Nifty 50 is still the only headline index down over the past 6 months. So looks like breadth continues to favor the broader market. The ROC chart from the weekly market sheet is on your screen. The Nifty mid-select continues to be the strongest of the lot. It's up 5.6% for the year and is now just about 1% away from reclaiming its all-time high. Nifty Bank, meanwhile, took a small breather this week, down 0.4%, but that's after a strong run over the last few months, and it's still less than 6% away from its all-time highs. If we look at the YTD numbers, the broader market continues to stay well ahead of Nifty 50. Microcap 250 has extended its lead to 12.1%, followed by small cap 250 at 8%. Next 50 is now at 3.7%, while mid cap 150 has inched higher to 2.3%. Nifty 50 meanwhile has recovered further, but it still remains down 7.2% for the year. The gap has narrowed over the last few weeks, but the broader story hasn't changed much. 2026 continues to reward investors willing to look beyond the headline index. Before we look at Nifty on various time frames, let's look at Nifty's monthly seasonality chart. June 2026 finished in green with a gain of 1.35%, recovering a part of May's decline. Historically, July has been even stronger than June. Over the last 27 years, Nifty has finished higher in 19 years, giving it a 70.4% win rate, the highest of any month so far in the calendar year. The average return has been around 1.75%, making July one of the seasonally strongest months for Indian equities. So in a way, this year was almost a textbook case in terms of seasonality. June once again lived up to its historical tendency of being a relatively strong month for the markets. The bigger question now is whether July can build on that momentum. Now let's look at Nifty on various time frames, starting with the weekly time frame. This week, Nifty gained 215 points or 0.9% to close at 24,271. It continues to trade comfortably above both the 10-week and the 20-week SMAs, with the medium-term trend remaining positive. More importantly, this is Nifty's highest weekly close in the last 11 weeks, dating back to week 16. One thing worth noting over the last 3 weeks is the steady expansion in the weekly candles. The total trading range has increased from about 371 points 3 weeks ago to 477 points the following week, and then to nearly 549 points this week. We're also seeing the candle bodies expand alongside those ranges, suggesting that the price is becoming more directional rather than simply oscillating in a range. What I've seen is that's usually a sign of increasing conviction from market participants. After last week's jump in volatility, things settled down a bit this week. Nifty's average daily range eased to 164 points from 242 points last week, although the weekly range still expanded to nearly 549 points. If we look at the daily ranges, Thursday was the quietest session with a range of just about 136 points, followed by Wednesday at 155 points. The bigger moves came earlier in the week, with Monday and Tuesday posting ranges of 195 and 206 points. Overall, the week was much more balanced without the sharp swings we saw a week ago. Now let's look at Nifty on a daily time frame. On the daily chart, the week started on a weak note. Monday and Tuesday were both down days, with Tuesday even closing below the 24,000 mark. But the bulls regained control in the second half of the week. Wednesday, Thursday and Friday all closed in the green, helping Nifty reclaim the 24,000 level. More importantly, Friday delivered a decisive close above the 24,250 resistance that had formed just a week earlier, ending the week at a fresh 3-month high. From a moving average perspective, the structure continues to improve. Nifty remains comfortably above the 21 EMA and the 50 EMA and has now also closed above the 100 EMA. The next major hurdle remains the 200-day SMA, which is currently placed around 24,870. Moving on to the hourly chart, the week started on a relatively weak note as Tuesday's sell-off pushed Nifty below the 50 EMA. But that weakness didn't last long. Wednesday saw the index reclaim the moving average and the momentum continued through Thursday and Friday. By the end of the week, Nifty had broken above last week's high and was trading comfortably above the 50 EMA. There was some profit booking during the final few hours of Friday, but the hourly structure continues to be in favor of the bulls. Talking about the Nifty monthly expiry, which happened on Tuesday, June 30th, well, the at-the-money straddle opened at around 114 points and quickly expanded to nearly 140 points by 9:45, as Nifty fell 183 points within the first 30 minutes of the trade. From there, the index staged a sharp 146-point recovery into around 11:30 am, only to reverse again with a 170-point decline into 3 pm. As you'd expect from a monthly, quarterly and half-yearly expiry, it was an extremely challenging day for non-directional option sellers, while long vol traders, that is option buyers, maybe had an edge. Let me know in the comments how your expiry went. Now moving on to what to expect in the coming week. Well, if I look ahead to the coming week, the technical picture has improved after Friday's strong close. Nifty has finally closed above the 24,250 resistance zone, which had capped the index over the past couple of weeks. The first level to watch now is 24,200. As long as Nifty holds above it, the immediate momentum remains positive. Below that, the 23,800 and 23,650 gap zones continue to be an important support area if we see a deeper pullback, that is. On the upside, the next major resistance remains around 24,600. A decisive close above that would bring the psychological 25,000 mark into focus. Overall, the bias remains bullish. After spending weeks consolidating above 24,000, the market has finally started pushing higher. The key question now is whether the bulls can build on this breakout and challenge the next resistance zone. Now, if I look at the straddle premium to gauge the expected range for the upcoming weekly expiry, which is on Tuesday, 7th of July, the Nifty at-the-money straddle closed at 173 points, down from 212 points last week, implying an expected move of roughly just about 0.71% on either side. That gives us an expected range of approximately 24,423 on the upside and 24,077 on the downside. With India VIX slipping below 12, the options market is pricing in a narrower move than last week. Now, whether the realized volatility stays within that range or surprises us again as it has over the past couple of weeks, it'll be worth watching out for. Well, India VIX saw a sharp decline this week, falling below 12 to close at 11.8. That's also one of the lowest readings we've seen since Jan 2026. A falling VIX usually means the market expects less volatility ahead, but as we've seen over the last few weeks, a low VIX doesn't mean the market can't have big intraday moves. We can still see sharp swings even when volatility expectations remain low. For now, though, the broader trend in VIX continues to be on the lower end, which is a supportive and positive sign for equities. Moving on to the sectoral performance this week. Well, the leadership shifted again this week with Nifty Realty taking the top spot after rallying 7.8%. Pharma followed with 3.1% gain, while consumption, CPSC and FMCG rounded out the top 5. Compared to last week, the leadership became far more defensive for some reason. Pharma led on to its momentum while FMCG and consumption joined the leaders. On the other hand, auto, FinService and banks slipped out of the top 5 this week. In all, realty was the standout sector by a wide margin, while the rest of the leaders posted more measured gains. Now, given that this is an end of month of sorts, I want to talk about the monthly trends from the TJI sectors that we follow. For the month of June, if you look at it, textiles topped at 11.3% on the government's move to scrap the 11% cotton import duty from June through October, reinforced by progress on the India, UK and EU trade deals. But textile is still at a net negative for over the year, so maybe this is just a blip rather than some kind of a sustained trend. Communication equipment gained 8.6%, driven by telecom infrastructure names like HFCL on fresh export orders, a large BharatNet win and the 5G and AI data center demand for fiber. It's been strong across 3, 6 and 12 months too, with only a marginal weekly dip. This is a sector we've spoken about in the past as well. Pharma, API and CRAMS rose 8.4% on perhaps what was a defensive rotation out of IT. Also, rising API prices letting manufacturers push through the hikes. This is one of the only 2 sectors here positive across every single time frame, suggesting a genuine sustained trend. Next, we have dairy products, which gained 8.2%, perhaps on falling crude, which is easing costs, FMCG rotation and a strong seasonal demand, something worth watching out for. Microfinance climbed 7.9% on early signs the sector's 2-year stress cycle is turning, with loan books growing and delinquencies falling. Along with pharma, it's another sector positive on every time frame. Now, looking at it from the 52-week high perspective, pharma, small cap, pharma and pharma API and CRAMS are all sitting exactly at their 52-week highs, and dairy products is just about 0.3% of its peak. If we combine it with what we saw earlier, pharma API CRAMS being one of the 2 sectors positive across every time frame, this adds real weight to the case that pharma's strength is genuine and broad-based and not just a 1-month blip. My suggestion, as always, is to dig through and double-click on these sectors, and I'm sure you may spot some gems there. So yeah, that's pretty much about the sector performance this week. Moving on to commodities, well, on the daily time frame, both gold M and silver M finally saw some relief after weeks of selling pressure. Gold M rebounded to around 1,47,500 after finding support near 1,40,000. Silver M also bounced sharply, climbing back about 2,40,000 levels after briefly slipping below the 2,20,000 levels. That said, the bigger picture hasn't really changed yet. Both gold and silver continue to trade well below the 50 MAs, which means the broader trend continues to remain bearish. For now, this looks more like a relief rally than some kind of a confirmed trend reversal. Looking at it on a weekly time frame, precious metals bounced back after a difficult run. Silver led the gains, rising 6.3%, followed by gold, which is at 2.4%. Copper also ended the week in green with a modest 1.4% gain. Energy, however, remained under pressure. Crude oil slipped another 0.5%, while natural gas gave up 1%. Despite the recent pullback, natural gas is still the standout performer of 2026, up over 163% for the year, while crude oil remains up around 41%. So that's pretty much on commodities this week. Before we wrap up, here's something I was playing around with over the week, that is YTD returns for various world indexes to see how they have performed so far in 2026. As you can see, Korea continues to lead the pack, up nearly 88%, followed by Taiwan at 59% and Japan at 35%. Among developed markets, the Nasdaq continues to outperform the S&P 500, while European indexes have posted modest gains. Back home, Nifty is still down about 7% for the year, with only Hong Kong's Hang Seng Index performing worse in this comparison. So, in 2026, the leadership has come from North Asian markets led by Korea, Taiwan and Japan. But you see, there's a problem with the previous chart. Everything you just saw was in its local currency and hence not really comparable. But what if we could adjust for currency and compare returns in US dollar terms? Well, I did just that. Interestingly, the overall leadership doesn't change much. Korea, Taiwan and Japan continue to be the standout performers even after accounting for currency. The biggest difference, in fact, is for India. Nifty's decline widens from 7% in rupee terms to over 12% in US dollar terms, reflecting the depreciation of rupee against the dollar this year. So while the local investors and global investors may look at the same chart, their returns can differ quite a lot once you take currency into consideration. That's why it's always useful to view markets from both perspectives. Back to our markets, and in summary, markets extended their recovery this week with Nifty gaining just under 1% and closing at its highest weekly level in the last 11 weeks. More importantly, the index finally broke above the 24,250 resistance and reclaimed the 100-day EMA, keeping the medium-term trend firmly positive. The broader market continues to lead, with Microcap 250 remaining the best performing headline index of 2026, followed by Small Cap 250, and Nifty 50 is still the only major index in the negative territory for the year. Nifty Bank took a breather this week but continues to trade close to its all-time high. On the sectoral front, realty stole the show with a sharp rally, while pharma continued its impressive run. When we look at the Tijori Indexes, pharma again remains one of the strongest themes, with multiple pharma-related sectors sitting at or near their 52-week highs. Commodities, especially precious metals, saw some relief. Gold and silver bounced after weeks of selling, although both remain below the 50-day moving averages, suggesting the broader trend to be still weak. So the bottom line for the week is, well, the bulls remain in control. As long as Nifty holds about 24,200, the focus shifts towards the next major resistance around 24,600 and potentially the psychological 25,000 mark beyond that. Fingers crossed. Moving on to what caught my attention this week, well, I have two recommendations and both happen to be about playing the long game, but in different ways. The first is the latest episode of the Morgan Housel podcast, The History of Uncertainty, the Magic of the Long Term and Overstating New Technology. Housel picks apart something he has heard for 2 decades at every talk he's given, that we live in a uniquely uncertain time. His case is that this feeling isn't new and every generation thinks it's living through unprecedented chaos, and the investors who actually do well are the ones who stop chasing the next headline and just let time and patience compound quietly in the background. An important reminder for all of us not to get too bothered by the negativity around us and keep our SIPs going. My second recommendation is a far meatier one. Intermission, the Ken's long-form podcast, has a new episode on Bharti Airtel. It masterfully traces the company's 3-decade journey from the brink of bankruptcy in early 2010 through surviving 2 takedown attempts by Reliance to where it stands today. Close to 4 hours long, but worth every minute. Sunil Bharti Mittal emerges as the clear hero of this epic corporate saga, and I will leave the rest for you to discover. Outstanding storytelling by Rohan, and I finished it in 2 days. Absolutely brilliant. Links as always in the show notes. Now over to the events to factor in for the coming week. Well, this week marked the quarterly settlement day, which means many of you would have received or will soon receive funds transferred from your broker account to your bank account. If you are an active trader, don't forget to transfer that money back to your trading account before markets open on Monday. It'll help you ensure your trades continue without any margin-related surprises. Looking ahead, the key event on the calendar is the FOMC meeting minutes scheduled for Wednesday, July 8th at 11:30 p.m. IST, just a day before Sensex weekly expiry on Thursday. If the minutes contain any surprises, expect volatility at Thursday's open. Other than that, there are no known major macro events lined up for the week. And finally, after months of spending weekends wondering what headline we'd wake up to on Monday, here's hoping that phase is finally behind us. That's it for the week, and with that, we wrap up this week's weekly market metrics. And yes, stay safe as heavy monsoon rains continue across many parts of the country, and I'll see you again next week. If you find this series useful, don't forget to subscribe to the channel, and yes, do share it with your friends. Until then, stay curious, stay steady, and enjoy your weekend.